One interesting macroeconomic feature of the week ahead will be the first estimate for third quarter GDP growth in America. This is due out on Thursday the 29th of October, and it will give economists, analysts and investors a chance to gauge how quickly the world's biggest economy is recovering from the first half's post-pandemic plunge. Remember that in the first half, the US fell into recession as output shrank for 2 consecutive quarters. On an annualised basis, GDP fell 5% in Q1 and by a third in Q2. Though if I may be so bold, presenting numbers on an annualised basis is a bit of a nonsense, as that assumes the growth rate for 4 quarters in a row will be the same, and that's just not going to happen. Anyway, to give you a forecast for Q3, the Atlanta Fed GDP Now survey is calling for a 35.2% rebound on an annualised basis. If you would rather look at the trend in the real or inflation-adjusted GDP growth figures for America on a year-on-year basis, here it is. Q2 showed a 9% drop, way less than the 21.5% collapse seen in the UK, for example. As a final point, remember the GDP data is backward-looking. Stock markets are forward-looking, and they are all ready to try and assess and discount growth in Q4 2020, 2021 and beyond to determine where corporate profits and company share prices might go. And on the company front, around a sixth of the FTSE 100 is due to update shareholders on recent trading, so there should be plenty of information flying around in the week ahead, especially as a few mid and small cap companies are also scheduled to release statements or results. They include the following, although some of these dates could still be subject to change. Cruise ship operator and former FTSE 100 member Carnival on Monday the 26th of October. Premier Inn owner Whitbread on the 27th. Next and GlaxoSmithKline on the 28th. Both oil majors BP and Shell, as well as WPP and banks Lloyds and Standard Chartered on the 29th. And to round the week off, NatWest Group, International Consolidated Airlines and Glencore on Friday the 30th of October. But the stock that could cause the biggest fuss in the week ahead for me is HSBC. The banking giant will release its third quarter results on Tuesday the 27th of October. The shares have taken a hammering over the last 12 months, falling by 50%, while the FTSE 100 is down by just over a fifth over the same period. That slump leaves HSBC shares trading at the lows reached at the very end of the great financial crisis and bear market in March 2009, and the same level as during the Asian debt crisis of 1998. In fact, the shares are no higher now than they were all the way back in 1994, just a couple of years after HSBC had bought the listing bank, the Midland. Now, there are many reasons for the last 12 months' desperate share price performance, and they range from the pandemic that started in China and then worked its way around the world, the recession that followed the pandemic, which has led to higher loan losses for the bank, falling interest rates that have, alongside competition and tighter regulation, served to compress bank lending margins, and also tensions in Hong Kong, which have left HSBC trying to appease China on one hand and international opinion and customers on the other. That discomfort in Asia is particularly acute. Remember that the Hong Kong and Shanghai Banking Corporation, HSBC, is where the lender's roots lie, and in the first half of 2020 it made all of its profit and then some in Asia, with the European operation showing a whacking great loss. The good news, at least, is that analysts do believe the third quarter of 2020 will not be as bad as the second. The current consensus forecast, according to HSBC's own website, is for a pre-tax profit on a stated basis of $2.1 billion, up from $1.1 billion in the second quarter. That would, however, still be less than half what the bank made a year ago, and there are two main reasons for this, both of which will be carefully studied by analysts. The first is write-downs of loans that have either gone sour or may be about to. Loan and asset impairments cost HSBC $3.8 billion in Q2, and analysts reckon they'll chalk off another $2 billion in Q3, thanks to tough economic times in the US and Europe in particular. At least China and Hong Kong went into the pandemic first, so they came out first, and that may help a little. The second is the lending margin on the loan book. This had reached just 1.33% in Q2, and analysts think it will dip to 1.23% in Q3, as central banks keep interest rates and bond yields low. You might not think that 10 basis points or a tenth of a percentage point would make a big difference, but HSBC's loan book is $1 trillion. So that 0.1% of lending margin adds up to $1 billion a year of profits over a full 12-month period. Analysts will also look to the loan book for any signs of growth. Deposits have surged recently as customers have sought the safety of cash, but an increase in loans could signal a return of consumer and business confidence, which might bode well for future economic growth. As a final point, HSBC will not declare a dividend for the third quarter, just as it passed the payment for Q4 2019 and Q1 and Q2 2020. That's owing to a request from the Bank of England that it retain the money so it can better withstand the pandemic and economic downturn. However, analysts do predict a full-year payment for 2020 of 6.6 pence a share, so that would have to be declared alongside the fourth quarter results early next year. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.